Forex trading is exciting, no doubt about it, but it's also full of risk. If you've been in the market for a while, you know how unpredictable price movements can be. That's why hedging strategies are so important. They're like your backup plan, giving you some cushion when trades don't go as planned. Today, we're diving into the best hedging strategies for managing risk in the Forex market and how you can use them to protect your account without killing your profit potential. Let's start with the most common type, direct hedging. This is when you open both a buy and a sell position on the same currency pair at the same time. For example, you go long and short on euro to US dollar. This way, no matter which way the market moves initially, one of your trades will be in profit. You're basically neutralizing the risk while waiting for a clearer direction. It's not a strategy to make massive profits, but it's great for damage control during volatile news events or uncertain market conditions. Another powerful technique is correlated hedging. You trade two currency pairs that typically move in opposite directions. A good example is euro to US dollar and US dollar to Swiss franc. If you go long on one and short on the other, you're essentially covering your bases. If one trade goes against you, the other is likely to move in your favor. Just be sure to check correlation metrics regularly. These relationships can shift over time. More advanced traders use cross-hedging. This involves trading pairs that share a common currency, like going long on pound sterling to Japanese yen and short on pound sterling to US dollar. It's a bit more complex because the impact of each currency needs to be understood, but it offers flexibility and can reduce exposure in volatile conditions. There's also grid hedging, which works well in sideways or ranging markets. This strategy involves placing multiple buy and sell orders at predefined levels. As price fluctuates, different orders get triggered, giving you the opportunity to profit from both upward and downward moves. It does require more margin, so it's best used when you're confident the market will stay within a certain range. Now, if you're thinking this all sounds like a lot to manage manually, you're right. That's where having a tool like the Trading Management Solutions EA can be a huge asset. It has a built-in hedge function that lets you instantly open a hedge position on any trade. You can even customize the hedge volume, and it'll automatically use the same stop loss and take profit levels, so everything stays organized. This kind of automation helps reduce stress, especially when markets move quickly. Some traders also use partial hedging, only covering part of their exposure. Say you're long on pound sterling to US dollar with a large position and the market starts turning against you. Instead of closing the whole trade, you can open a smaller short position to offset some of the risk. It gives you breathing room while keeping the original trade alive in case the market recovers. Another smart tactic is hedging using different time frames. You might take a long position on the daily chart and a short scalp on the 15-minute chart. The idea is that the short-term trade protects you during retracements, while the long-term trade remains valid based on the bigger trend. It's a great way to combine analysis and reduce drawdowns. Whichever strategy you choose, the key is to stay disciplined and have a plan. Don't hedge blindly. Understand why you're doing it and when it makes sense. Hedging isn't about avoiding losses completely, but about managing them in a smarter way. And when you've got tools that support your strategy, like automated order management, quick hedging features, and built-in risk control, it becomes much easier to implement these techniques consistently. That's where the Trading Management Solutions EA really shines. It's like having an assistant that not only executes your hedging strategy, but helps you track and manage performance in real time. So whether you're protecting your trades during a news spike or balancing exposure across correlated pairs, hedging can be your best friend in the Forex market. Stay smart, stay protected, and keep your strategy sharp.